Good morning, and welcome to the first interim meeting of the Interim Joint Committee on Banking and Insurance. We do have a full agenda this morning. We'll be getting our financial institutions update from the Department of Financial Institutions, Kentucky Credit Union League, Bluegrass Community Bankers Association, and the Kentucky Bankers Association. At this time, we will have the secretary call the roll, and if the members would please indicate whether you're present in the room, in your annex office, or back in your district. Madam Secretary.
Senator Rocky Adams. Senator Alvarado.
Present in the room.
Senator Girdler.
Here in my district.
Senator Howell.
Present in District 1.
Senator McGarvey.
Present in the district.
Senator Parrott.
Present in my district. Were you able to hear that?
Yes, thank you.
Thank you.
Senator Schickel. Senator Smith.
Present in my district.
Senator Storm. Representative Bentley. Representative Fisher. Representative Flannery.
Present in the room.
Representative Frazier.
Present from district.
Representative Gooch. Present in the room. Representative Hatton.
Present in the room.
Representative Kirk McCormick. Representative Koenig.
Present in the room.
Representative Cole Carney.
Present for my district.
Representative Lewis.
Present in the room.
Representative Lockett.
Here in the room.
Representative McPherson. Representative Meredith. Representative Roberts.
Present in person.
Representative Santoro. Representative Smith. Representative Stevenson.
I'm present in my district.
Representative Upchurch. Representative Westrom. Co-Chair Carpenter.
Here in the room.
Co-Chair Rowland.
Present here in the room. We do have a quorum, but since this is our first interim meeting, we do not have any prior minutes to approve. So at this time, are there any members on the committee that would like to seek recognition for a potential guest in the room? Probably not happening today. So if with that, we'll move right on into our agenda, and we'll start with an update from the Kentucky Department of Financial Institutions. Commissioner Charles Vice will be joining us remotely. Commissioner, if you're online and you're ready, go ahead and introduce yourself and you can begin.
Good morning. Can everyone hear me okay?
Can we turn his volume up just a little bit? Commissioner, can you turn your volume up a little bit?
Let me see. I don't think I have the, oh, wait a minute.
Okay, we improved it a little bit. Go ahead, Commissioner.
Okay, so you can hear me now? All right. Well, first I want to thank Chairman Rowland and Chairman Carpenter and the members of the committee for letting me testify today. Thank you also for working with me on allowing me to testify remotely. I am working from two screens, so if you see me looking up, that means one of two things. I'm either referencing my slides or I'm praying, one or the other. But I am Charles Vice. I'm the Commissioner for the Department of Financial Institutions in Kentucky, and the department oversees the financial services industry in Kentucky. And the discussion topics for today, I'm going to talk about Dfi Operations a little bit as we work through the pandemic, and I'll give you divisional updates. We have 3 divisions within the department, the Depository Division, Non-Depository Division, and the Securities Division. When I get to each division, I'll give you a real brief update on what industries we regulate within that division. And I'll conclude the presentation today with a brief discussion on the Paycheck Protection Program lending in Kentucky, giving you some volumes of loans that originated and how much is remaining outstanding as of to date. Also at the end, I'll be glad to take any questions when we get to the end of the presentation. Also, if you have any questions that you didn't have the ability to ask during the meeting today, I'd be glad to ask anything after the meeting or answer any questions after the meeting as well. You can either just email me or let the LRC staff know. So DFI operations, during the pandemic, we did issue 4 guidances to the industry. Each one was industry specific, and the guidance was tied to the state of emergency, which means once the state of emergency ends, the guidance ends as well. Most of the guidance had to deal with operations, having entities and regulated entities work with their customers, trying to ensure safe access to services, looking at social distancing. A few of this guidance also addressed healthy at home initiatives, giving some relief to the industries relative to that topic. And overall, though, the message was please work with your customers, provide them some extensions, loan modifications if possible, reduce fees. Those were not mandates. Instead, they were just asking the industry to work with their customers if they could. And I'm very pleased to report a lot of industries did take a lot of actions and initiatives to help customers. They come up with some very inventive ways to offer services and provide services while also meeting social distancing requirements and mask mandates. From examination procedures, we are mandated to continue examinations. We did not do a pause. Some federal agency paused their examination activities during the pandemic. We did not. Instead, we went predominantly to an off-site mode from March 2020 through July 2021. We have conducted some on-site procedures, but those were extremely limited during the pandemic, meaning that we would go on-site very infrequently to some entities just to obtain information and collect information that could not be transferred to us electronically. Then we took them back to work locations to do the examination. In addition to that, as I'm doing now, we remotely conducted our examination meetings, and we had virtual board meetings at the end of examinations. Our on-site examination activity did resume mid-July 2021. However, future examinations will use what we're calling a hybrid model, and we are conducting as much as we possibly can off-site. And when we go on-site to a regulated entity to do an examination, we try to take a minimal team and be on site for just a minimal amount of time, whatever time we need just to collect information and conduct the examination the remainder of the examination off site. So for divisional updates, I'll start with the depository division. This would include Kentucky State Chartered Banks and Kentucky State Chartered Credit Unions. Most of them have returned to the office. Lobbies have been reopened. Customers continue to use online and mobile platforms that were adopted during the pandemic. And those have continued to be used quite a bit instead of accessing face-to-face services. Financial institutions, as I'll get into in a little bit, are ready to lend. They do have a lot of liquidity on their balance sheets, and we're in a very low rate environment. So banks and credit unions are in a mode where they can lend. Rates are low, and they have a lot of excess liquidity at this time. This liquidity is shown in this chart right here. There's been a significant surge in deposits during the pandemic, and the black lines on the chart represent actions that were taken by the U.S. Congress to provide stimulus and stimulus funds. And so after each one of those are passed, you could see some pretty significant growth, both in the Kentucky Credit Union deposits and bank deposits, in the tune of 15%, 20%, and up to 25%. So we've seen some pretty significant dollars flow into our insured depository institutions after these stimulus funds were passed. And that's creating a lot of liquidity in our institutions. And a lot of banks and credit unions now are looking for opportunities to lend to customers and members. Kentucky bank performance. And again, this will bear out what I was talking about earlier. We've seen a pretty significant surge in growth in total assets. Not so much in total loans, but a pretty significant surge in total assets during this time frame as well. So right now in Kentucky, we have 108 state chartered banks. 16 of those banks are less than $100 million. And you can see the growth rates there, asset growth. And look at pay particular attention, or I'll draw your attention to year-end 19 compared to year-end 20. So at the end of 19 in Kentucky banks, there was $53 billion in total assets. At the end of 20, that increased about 15% to 61.4 billion. And in the first quarter of this year, they've also grown another 3 billion to 64 billion. Total loans over that same time frame went from 38 billion. They grew 9% in 20 to end that year at 41 billion, and have remained pretty much steady. So there's still a lot of liquidity at the banks. Loan growth has been slowed a little bit, but there's still a lot of liquidity at the institutions that they are needing to lend out. So looking at the overall performance, there's a couple metrics that I look at each quarter, and I compare our state to national and also the states that are around us. I'm not going to read each number on this chart. This is really provided for your information, but I will go over the Kentucky line. I would have you keep in mind that when you see national up there, that's all the state chartered banks in the United States. That does not include the OCC chartered banks. So that is just the state chartered banks in the US, because I wanted to compare apples to apples, and our department just oversees Kentucky state chartered banks. So Kentucky banks have employ about 11,300 people. The net interest margin, which is basically the result of what is the rate when you take what is earned on assets, i.e. loans, and minus out what is earned or what is paid on deposits and funding. That the result of that is the net interest margin. And right now, Kentucky has a net interest margin of 3.48%. That is number one compared to the states that are around us and state chartered banks nationwide. The return on average assets is a measure of overall profitability. Historically, a 1% or better is considered a really good return on average assets. Right now, for March 31st, the first quarter, Kentucky banks earned 1.45% as a return on average assets. That's number three, with Indiana coming in at number one at 1.56. The return on equity, which is the rate that the shareholders earned based on that return on average assets, was 13.44. That was number three as well, with Indiana again leading the way at 14.39. And the final measure or ratio I have on this chart is the capital ratio, which that's basically taking the bank's capital and dividing it by the total assets. That's at 10.47%. That's a very strong capital ratio, and it's number one compared to the states around us and the nation as a whole. So again, a very strong performance for our banks through the first quarter of this year. Credit unions, again, very similar information, looking at the states that are around us and looking at the state chartered credit unions on a nationwide scale. Again, I'm just going to read the Kentucky line. Right now, we have 20 state chartered credit unions. Their net worth ratio, which is similar to the capital ratio, again, taking their net worth, dividing it by total assets, 10.87%. That's number three. That's number three compared to the states that are around us. Return on average assets was 0.867. That's number seven, with Illinois being number one. And the net interest margin, Kentucky's at 2.61, and that's number five compared to the states that are around us, with West Virginia leading that at 2.94. So again, very sound, very solid performance by our state chartered credit unions as well, with a very strong capital ratio. Next, I'll go to Non-Depository Division, and this division would oversee basically non-bank lenders in the state, any money transmitters, or check cashers. These are the particular things that we license or register. So it consists of mortgage companies and brokers, mortgage loan originators, consumer loan companies, industrial loan companies, check cashers and deferred deposit licensees, limited check cashers, and money transmitters. So these are the number of individuals and companies within those categories. And where we've seen a lot of growth in the mortgage market is very strong right now is in the mortgage space, where we've had a pretty significant increase in the number of licensees or mortgage companies that we license. In 2020, that was a 17% growth in mortgage companies and brokers, and a 34% growth in the number of mortgage loan originators. And through June 25th, 2021, We've seen a 13% increase in mortgage companies licensed in Kentucky and an 11% increase in the number of mortgage loan originators. Those would be individual mortgage loan officers. Like I said, the mortgage industry is really going strong right now in Kentucky. Home prices are up significantly, and a lot of this has to do with supply and demand. The housing demand is very low right now, housing supply is very low right now, and demand is really high. So we're just running into some supply and demand forces here. But from a nationwide perspective, the median home prices went from $322,000 back in 2020, and right now it's at $358,700 for a median home price throughout the nation. In Kentucky, that's a little bit lower. I believe right now the median home price has increased from about $175,000 to about $196,000. Last year, the median home price in Kentucky alone increased 10%. And so far, year to date this year, it's increased another 10%. So home prices are up over the past year and a half at about 20%. In addition to that, we're in the backdrop of a very low rate environment, which makes homes more affordable. Although this is a pretty long time frame on a scale, I just wanted to give everybody a sense of what mortgage rates have been doing over the past 40 years. And one of the things that's interesting to look at here, again, this is the interest rates on a 30-year fixed rate mortgage dating back to the 1980s coming forward. And if you look at that, a 30-year fixed rate mortgage, and if you're borrowing $100,000, if your interest rate is 18%, your mortgage payment would be $1,500 per month. At 3.3%, so again, a 30-year fixed rate mortgage, $100,000 at 3%, the monthly payment is $422. So this very low rate environment, again, it creates this housing demand, and it also provides access to people to be able to afford more homes. This is looking at mortgage origination comparison, and again, this is just non-depository mortgage companies only operating in Kentucky. So this does not include banks or credit unions. This is just non-depository mortgage companies. So looking at 2019 compared to 2020, in 2019, there was $7.8 billion in mortgages originated. In 2020, that increased to $14.9 billion. The number of loans went from right at 44,000 to a little over 75,000 loans originated just last year. And the average loan size you can see there, which kind of mirrors the median home price, went from 178,000 to 196,000. And again, that's the average loan size comparing 2019 to 2020. For smaller dollar loans and money transmitters, one of the interesting things we have seen through the pandemic is payday loans and deferred deposit business. The volume of those loans declined 36% in 2020, and that volume also declined an additional 10% in 2021. Money transmitters, many of those locations did work remotely, but still provided services, and the number of licensees and the volume of activity that we're seeing in money transmitters has remained pretty stable throughout this time frame. Finally, for the final divisional updates, look at the Securities Division. And on the Securities Division, they oversee broker-dealers, investment advisors, and issuers. This chart gives you some information about how many licensees and individuals that we have licensed and registered under the securities area. We have seen a little bit of increase in broker-dealer agents and issuers. They're up about 6% in 2021. And the rest of the categories have remained relatively stable, but still seeing some pretty good growth, pretty sound growth in the broker-dealer agents and issuer agents that are registered with Kentucky. Some of the effects on the securities industry are similar to the other industries we regulate. Broker-dealer and investment advisors have closed some offices, physical locations, and the reason being is a lot of those services have went to an electronic delivery format. And so even though some offices have been closed, again, there is still a high demand for securities services, and just those have gone to an electronic format. And this has caused some some clients that resisted online services have adapted to that simply because the ability to meet in person has been diminished over the past years as we've been dealing with the pandemic. The demand for services have caused an increase in representatives, which we saw on the last slide. And uncertainty in the markets have caused some individuals and some investors to move to non-traditional investments with increased risk and fraud. And I'll talk about those a little bit on the next slide. Some market concerns that we're seeing right now in the security space. Social media platforms are being used to promote agenda-based trading as opposed to fundamental-based trading. So instead of looking at a company's viability and its financial strength, some social media platforms have been used to, if you will, market or pump up demand for some stock once it reaches a high or a certain value. The players that are trying to do this then basically pump and dump the stock. They sell the stock while it's at a high level and make a profit from it that way. We've also seen a significant amount of activity in the cryptocurrency space. A lot of individuals are looking at that as an alternative investment these days. And with cryptocurrencies, it is higher risk and more volatile. One of the risks associated with it is cryptocurrencies are typically not backed by any fiat currencies. There are some exceptions to that relative to stable coins, but just a typical cryptocurrency is not backed by a fiat currency, and there's extreme price volatility with it. We've also seen some investors, as typical when you have some uncertainties in the market, go to precious metals, i.e. gold and silver. And in some cases, we've been seeing an uptick in some fraud associated with gold and silver selling. So to conclude the presentation, I'll briefly talk about the Paycheck Protection Program, giving you some volumes that have been originated in Kentucky. So when you look at this slide, there's several different dates on here, and I'll go through these just real quickly. So on the first line, it says approved through August 8th, 2020. And the reason it says that is the initial Paycheck Protection Program was initiated in the CARES Act, and that funding ended on August 8th. So that's why we have this date here. The number of loans originated in Kentucky was 50,655. The net dollars was 5.3 billion, and the average loan size was 104,000. Congress did act again and extended the Paycheck Protection Program Act, and that was the funding on it was through May 31st. During that funding period, there were 80,225 loans originated in Kentucky, and that totaled 2.6 billion. And the average loan size during that funding period was right at $32,000. Currently, loans outstanding in Kentucky, so these are Paycheck Protection Programs that have not loans that have not been paid off or forgiven, total right at 32,000 loans, and the total dollar amounts 2.5 billion, and the average size of that is 78,000. So the last slide I have here, and this really is an indicator of how important the financial services industry was in getting out this stimulus funds through the Paycheck Protection Program. And again, I've got this broken down to the original CARES Act and the Extension Act. And these are the percentages that of those funds that we just talked about. This is looking at the U.S. in total, though. How much flowed through banks and savings and loans, fintech companies, small business lending, credit unions, and other. So as you can see, this was the financial service industry was really integral in administering this program and getting this relief to companies and getting the funds to companies. So Chairman, I will end my presentation there and be glad to take any questions that you may have.
Thank you, Commissioner. We always appreciate your presentations to our committee and working with us throughout session on issues that impact our community banks and credit unions throughout the state. Any members have any questions or comments regarding the Commissioner's presentation this morning? Representative McPherson.
Yes, Commissioner. Thank you. Have you seen any loan defaults due to the problem with the renters moratorium where they just went off this week, this last month? You seen many problems with that?
One of the things that I've been very pleased with, and actually surprised with, I should say, is that the past due rates and the loss rates at our institutions have been relatively low to this point. Now, one of the things that's going into this as well is that these deferment periods and rental deferments and mortgage deferments are recently ending. So we may not see the impact of that for a while, but as of right now, we have not seen a significant increase in either past due, foreclosure, or defaults as of right now.
Thank you for the good information. Thank you.
Yeah.
Representative Smith.
Thank you, Mr. Chairman. Commissioner, just a quick topic on the crypto. Do you have any kind of vision in the future of any kind of regulations, insight on what advice you're going to give banks on dealing with the crypto? And also, are you waiting for the federal to take a lead in it before you look at it as a state issue?
A great question, and this is such an emerging industry. I do know some states have passed statutes regarding special purpose depository institutions. Wyoming was the first one to do that. I believe Nebraska passed it last year. This is definitely a topic that we're looking at. And one of the challenges with cryptocurrency is, one, it's so new, it's so innovative, and people are using them for such a wide variety of things, and it doesn't really fit into one of the boxes that we have right now, i.e. depository, non-depository, or securities. And so one of the challenges there is taking the right approach to this, but we are definitely looking at it. We're definitely engaging some companies with this. We're talking to other states about this, and we're trying to develop what's the best, we're taking a look at what's the best way for Kentucky to move forward to regulate this and provide some acceptable consumer and investor protection pieces with it, but also allowing the innovation to occur as well.
Quick follow-up, Mr. Chairman. Are you aware of the machines that are being placed in businesses right now with Bitcoin?
Would that be like an ATM,
yes,
Bitcoin, and things
yes,
like
sir.
that?
Yes, sir.
I'm not aware of any being played. I think there may be one in Louisville. I don't think they're widespread throughout Kentucky yet, but yes, I am aware of these types of machines that are encouraging people to invest in Bitcoin and other types of cryptocurrencies.
Is it my understanding these machines can do a transaction on conversion, American dollars to Bitcoin on site? Is that your interpretation of it?
Yes, usually you're making some type of payment, either a currency or some type of electronic payment via debit card or credit card, and you're purchasing the cryptocurrency with it, i.e. you're getting a wallet that has the public and private key associated with the cryptocurrency that you're buying, and you do own it from that point forward, yes.
One more follow-up. And the only reason I'm asking you this is because it's starting to become a discussion in my district. Is there anything in the future that you're going to be bringing to the legislation, as far as legislation to our committee, that's going to be doing immediate? The last session we did pass some legislation that dealt with some crypto. And the reason I'm asking is, when you have someone coming to you for making a recommendation on whether they should be entering that type of investment, I'm not an investment banker or anything like that, and I don't give that type of advice, but what they're looking for is regulation. Are you being hit with the same type of questions, the correspondence from the public reaching out to find some sort of regulation on these crypto coins? And what I'm reading about them is that is what the biggest fear is right now. But there is, and you can correct me, there is institutions that are invested in it now, banking institutions that are starting to invest in crypto. Is that correct? Is that your understanding that it's on a national level? I'm not talking about a Kentucky bank particular, but there's starting to be institutional investments. So is there a guidance in your office or that you're seeing from the governor's office or from leadership somewhere that's telling you to be looking at some sort of a guidelines for us to be considering? Or again, are you waiting on the sideline to see what the federals do?
Yeah, one thing I want to show you is we are definitely, and I do not take this approach at all of waiting on the federal government to do anything. So our approach to this is we're looking at it. We are working with the governor's office on what's the appropriate recommendation here and what's the best path forward to protect, again, Kentucky residents and Kentucky investors, because this is, like one of the screens said, this is a very high risk activity. And a lot of it is not known publicly or generally about what the risks that are being accepted with either owning or investing in Bitcoin or other types of cryptocurrencies. So we definitely want to be at the forefront of this, and the department is being very proactive in trying to come up with what's the best solution with this.
Okay. Thank you, Mr. Chairman.
Thank you. We have two final questions on this presentation, and then we'll move on to our next presenter. Representative Flannery is first.
Two questions, please, Mr. Chairman. The first, Mr. Commissioner, Representative McPherson alluded to, but do you have any recommendations as to what we need to do to be mindful of tenant-landlord situations with the moratorium on evictions? You indicated that it's better than you thought it would be, but I guess looking forward, any recommendations as to what we could do to help?
Right now, we are definitely looking at this issue. We do know that there is a potential for some activity to resume relative to foreclosures and evictions and things of that nature with the moratorium ending. We have always encouraged our financial institutions to work with their borrowers as much as possible. That's one of the strong messages that we sent through our guidance. And I know this probably is not the answer you're looking for, but one of the things that I've always enjoyed and just think it's a strength of Kentucky is that our financial institutions do the right thing. So they're going to work with their customers. I have faith that they'll work with their customers as much as possible, whether that be a landlord situation or whether that be a tenant that is struggling and has financial needs. So we are looking at this. We are in contact with the industry about it. But I do have a strong faith in our financial institutions that they will do the right thing relative to the companies that they're dealing with that serve as landlords, but also as the tenants and or borrowers themselves that may be in a tough financial situation.
Second unrelated question. I've had several merchants and business people that still actually that still receive checks for payment have indicated there's been a surge of cold check fees. Any indication as to how many cold checks, if that's on the rise, or what the fee amounts, if they've increased?
I have not seen an increase in fees yet. I do know several institutions have actually either reduced their fee or may even put it on hold for a while. But I don't have any information relative to this that I can share with you at this time. But from overall, I have not seen an increase in NSF fees. And I do know that some institutions have actually waived them for a period of time.
Thank you, sir.
Yes.
Thank you. And our last question on this presentation will come from Representative.
Thank you. Thank you, Commissioner. My questions are around the PPP loans. Two-part question, so I'll smack it together for you in the interest of time. The first is the first draw versus the second draw amounts is the second draw amount is appreciably lower. We're going from 104 average to $31,000 average on the loan. So could you talk a little bit about any ideas you may have for why that's so much less, especially since the second round allowed for more vendor payments, broader payments usage for that second round of draws. So I'm confused as to why it might be lower, and it's concerning to me that perhaps it's a sign that we should have some concerns with our small businesses especially. And then second, just looking at the crush of these loans, so I'm assuming we add this 50,000 plus this 80,000. So if we're looking at 131,000 loans that your institutions have processed, plus an uptick of more than 30,000 more mortgage loans this year. Can you just talk about how your institutions are handling that kind of crush of applications? Thank you.
Yeah, and I think that I'm hoping that the KBA addresses this and has more stories, with you will, about how the institutions are able to handle this, because you're right, this did create a pretty significant disruption in operations. There were many stories that I've heard where institutions were trying to get applications online and through the SBA and actually had employees sleeping on cots till 1, 2 o'clock in the morning trying to get applications through. One of the things to keep in mind with the PPP loans, though, is that there is the forgiveness piece of them. So a lot of these are going to be dealt with, paid off through a forgiveness piece. Initially, that was capped at a $50,000 automatic forgiveness. And just this week, the SBA opened up a portal to allow borrowers themselves to go in and ask for forgiveness and do an automatic forgiveness of $150,000. So I do think as time goes on, a lot of these will be removed from balance sheets via the forgiveness piece and our payment piece. And regarding the mortgages, the mortgage industry today pretty much functions as a originate to sell model. So a lot of these mortgages, even though there's been a significant uptick through our financial institutions, are basically not being held on the balance sheets of our credit unions and banks, but instead are usually finding their way into the secondary market via a mortgage investment vehicle. And I didn't talk about the average size. The average size, one of the big differences there is that on the second extension piece of it, it was specifically geared toward trying to make sure that smaller businesses have access to it. That's why you see this average size go down quite a bit. And I think because of the focus being on the smaller businesses, you weren't getting the $3, $4, $5, and $6 million loans. Instead, it was going, more loans are going out in smaller dollar amounts to smaller businesses. So that's one of the big differences between the average loan size of the first draw and the second draw, is there was a purposeful, concerted effort to try to engage smaller businesses with PPP loans.
Thank you, Commissioner. We appreciate your time this morning, and thanks for kind of adjusting on the fly and joining us remotely. Certainly good to hear from you.
Thank you for working with me on that. I appreciate it.
All right, we'll move on to item number 2 on the agenda, which is a presentation from the Kentucky Credit Union League. And we have with us Debbie Painter, President and CEO. Debbie, welcome to the committee again. When you're ready, introduce yourself and you may begin.
How about now? Okay. Good morning, everyone. I want to say thank you to both Chairman Rowland and Chairman Carpenter for the opportunity to speak today, and to thank this committee for not only allowing me to speak, but for your service to your community, your district, and the state of Kentucky. I am honored today to tell you a little bit about credit unions. The commissioner did a great job at going over like the kind of the financial update. So what I would like to do, even though there's some slides in there on our financials, I'd like to just talk to you about credit unions. I will tell you, I am technologically challenged. So if I fall behind on my screens, don't worry about you can just listen and not have to read. So what I want to tell you about today is the unique structure of a credit union. A credit union is member-owned, and we are not-for-profit financial cooperatives. This structure makes us different in the financial industry from other organizations. We actually started, this is not on the slides, but credit unions actually started back in the mid-1800s in Germany. We had a group of farmers who were having problems getting loans, and so they decided to just pool their dollars together and just lend to each other. So that's actually where credit unions began. They didn't get to the United States until the early 1900s. But our board of directors are all volunteers, and they're all elected from the membership. Credit unions can be federally chartered and they can be state chartered. And as you heard from the commissioner, we have 20 state chartered credit unions. My slides will show that there's 21, but we've had one since convert from state over to a federally chartered credit union. But Kentucky became the 13th state to enact a state credit union law, and that was in March of 1922, and it actually predates federal credit union law by like 12 years. It was passed in Congress in 1934. The first credit union that was chartered in Kentucky was Berea Credit Union, and unfortunately it merged a few years ago, so that one no longer exists. The second credit union that was chartered is Louisville Federal Credit Union, and even though it has the word federal in its name, it is actually a state-chartered credit union. It was established in 1924, and I'm glad to say that it is still in existence today. Very strong, very healthy small credit union who is serving federal employees. Then the first credit union in existence, which again came in 1908, which is St. Mary's Bank. And I know it's kind of odd to have a credit union with the name bank in it, but back over in Germany, when credit unions were first organized, they were actually called People's Bank or People's Association before they became known as credit unions. At our peak in Kentucky, we had around 280 credit unions across the state. Nationally, we had a little over 22,000 credit unions. Today, unfortunately, we are down to around 5,100 federally insured credit unions, and in Kentucky we are down to 59. So we have 59 credit unions across the state. This time last year we had 63. So unfortunately we have lost 2 credit unions within 12 months to mergers, no liquidations, just merging into another credit union in order to better serve their membership. All credit unions are federally insured up to $250,000 under the National Credit Union Share Insurance Fund. This share insurance fund, unlike the FDIC, is self-funded by credit unions. Credit unions are accessed 1% of their deposits that's paid into the insurance fund, so that there will never ever be a taxpayer bailout for a credit union. We will pay any credit union losses are paid by credit unions. There are no privately insured credit unions in the state of Kentucky. There are some smattered across the country, but none in Kentucky. The smallest credit union in existence today, as you can see, is less than $1 million in assets. It is a small credit union located in Russellville. It is inside their primary sponsor, which is a factory. Our largest credit union that's domiciled in Kentucky is Abound Federal Credit Union, and today they are knocking on about $1.8 billion in assets. So you can see there's a big difference between our smallest, which is less than $1 million, and our largest, which is $1.8 billion. I can tell you that in the state of Kentucky, 35 out of our 59 credit unions are under $60 million in assets. So we are predominantly small, but I like to say we're very mighty in the way that we serve our membership and in the way that we serve our communities. The other thing I'd like to bring to your attention is that credit unions employ about 2,300 employees across the state, and we have right at 915,000 credit union members, which sounds like a lot, but we're in a state that has over 4 million citizens, so 915 is actually a relatively small number compared to other states. So credit unions are going strong in Kentucky. They're doing well. The commissioner talked about the fact that we are just shy of 11% in net worth. State chartered credit unions tend to be a little more well capitalized than federally chartered, and credit unions in Kentucky tend to be more well capitalized than those across the nation. So we have a higher net worth, capital net worth, than those others outside of our state. So again, we're a strong state. We're small, and unfortunately, we this time next year may be even a little smaller than we are today. But even though we are decreasing in numbers, our assets are growing and our members are being served. Like I think you'll find when Mr. Cassidy comes up and talks about the banking industry, we are faced with some challenges. And mainly, I listed 4 down here for you. As the commissioner alluded to, with all the stimulus payments, credit unions, just like the banks, have an influx of dollars in their accounts where members and customers are hanging on to those dollars and aren't spending those dollars and aren't borrowing those dollars yet. So we have some artificial growth out there, and as the commissioner alluded to, credit unions are ready to lend. Credit unions' bread and butter as far as lending goes is consumer lending. The auto loans, new and used, signature loans, that type of thing, occasionally recreational vehicles. So we are ready to lend. We have the dollars to lend. And if we could ever get some chips in the vehicles, we'll be ready to roll. So, but cybersecurity continues to be a big issue. I think you'll find that across most financial industries that tends to be a big challenge. We are working hard to prevent fraud, prevent any cybersecurity breaches in the financial industry. Probably the biggest thing right now is talent retention and recruitment. Credit unions and community banks are up against the Sonics and the McDonald's that are all of a sudden offering $13 to $18 an hour. That is hard for credit unions, small credit unions in the state, to be able to pay $18 an hour for an entry-level employee. So just think about the fact that you could work at Sonic and almost make $40,000 a year. And it's a struggle right now to figure out what people want. What do employees coming on board want? Do they want a higher salary? Do they want vacation time? Do they want benefits? It's kind of all over the board right now. Again, talent recruitment, talent retention, and the rising costs are something that I think all financial institutions are facing. What I want to leave you with before I open it up for any questions is to let you know what credit unions are focused on. Credit unions, again, are member-owned, and at the core mission of a credit union is to be able to maximize the financial well-being of all of its members. And financial well-being means more than just financial literacy or financial education. Those are big components of it. But when you look at financial well-being for an individual, you're looking at food security, you're looking at housing security, job security. Do you have enough in your account to be able to handle a financial shock? If your washer stops working or you need new tires for your vehicle, can you handle that expense? It's also, financial well-being is also about being able and being confident to make the right choices with your dollars. And how do you feel about your income and about your savings and about your life and your family well-being? So credit unions are really focused on helping each and every member achieve their financial well-being. I want to encourage you, if you have time and you have nothing else to do, which I'm pretty sure most folks on this panel have enough to do, but if you find yourself wondering about a little bit more about it, you can go to www.movekentuckyforward.com. That is a website that we have developed on the credit union industry that will talk about more about what credit unions are doing to help their members achieve financial wellness. I also want to encourage you, if you haven't had the opportunity to meet Matt Frye. Matt Frye is the new executive director for the Kentucky Financial Empowerment Foundation. And as you recall, back in 2018, when the legislature passed the mandate that financial literacy must be taught via a course or program to all incoming freshmen starting in 2021 school year, that they must have at least a course or a program before they graduate. But it was an unfunded mandate. So the credit unions, along with the treasurer, and it was the treasurer's initiative, is to create this Kentucky Financial Empowerment Commission. So in 2019, the legislature passed the law and created the commission. The commission needed funding, and the treasurer came to our credit unions and said, here's my vision, here's my idea about how can we get financial literacy across to every consumer across the state of Kentucky. And the credit union said, we're your partner. So for 3 years, the credit unions have committed $350,000 per year to help fund this commission. And we're very proud to be a part of that. And again, financial literacy and financial education is just a part of a credit union's mission and just a part of helping people achieve financial well-being. So I'm very proud to represent this industry, and we are a unique industry, but if you have any questions, I'll be glad to address them. And again, I apologize for the whole, PowerPoint thing. So,
thank you, Debbie. We really appreciate you being here with us this morning and your presentation. We do have a question from Senator Schickel or comment.
Thank you, Mr. Chairman. Debbie, it's good to see you again. Thank you for your compelling testimony. And I just want to offer a little bit of testimony about credit unions. When I was in the first grade, my mother would always give me a quarter for lunch money. But on Wednesday, she'd give me an extra quarter to deposit in the school credit union. And I remember the first time I did that, going down there with her in the first grade, and Mrs. Moran was in this little room and she was puffing on a cigarette. And I loved the smell of that cigarette smoke as a little boy, so I was leaning over there, and she had her glasses down on her nose like I do, and she'd enter that quarter in there and enter it in there by hand, and she'd give me back this book. And by the time I was in 8th grade, I had a whole book full of quarter deposits. And then when I graduated from high school, the credit union lent me my first loan on a I think it was about a 62 Chevy Bel Air that had rust all over it, and they gave me a loan on that. So I really appreciate what credit unions are doing, especially for people that don't have much money, like I didn't have back in those days. And anything I can do on this committee to help credit unions, I'm going to do. Thank you, Mr. Chairman.
Thank you, Senator. Any other member on the committee wish to be recognized for a question or comment?
I'm just willing to guess that Senator Schickel still has a lot of those quarters.
I can remember the books that you put your quarters in. So, and I can tell you that we have credit unions that are in high schools today. These are full functioning branches that are actually ran by the students. So we still have those today. Any other questions?
Any other questions or comments from members? If not, thank you again, Debbie, for being here.
Thank you so much.
Always good to see you.
It's good to see you guys. Thank you so much.
Thank you. Our next presentation this morning will be from the Bluegrass Community Bankers Association. And I believe we have Christy Carpenter, the president-elect, here this morning. Christy, welcome. And when you're ready, you can introduce yourself for the record and you can proceed.
Yes, there you go. All right. Thank you, Chairman, for having me here again today. The last time we were together, I was telling my story about PPP loans, and thank goodness I have a topic today about community banks and the issues we're facing and what we're dealing with. My name is Christy Carpenter, and I'm pretty homemade. I grew up back a country road called Tick Creek, like a creek of ticks. I was the daughter of a sharecropper who raised cattle and tobacco and corn and pretty much all of our food. We lived on the farm, and it provided everything for us. my grandmother made all my clothes until I was about 14 years old, and I demanded that we get to go to the mall, buy something for high school. It was a wonderful life, and we lived off the land, and we were happy. And just like my dad, I did not attend college, except for taking a few night classes in computer programming. And I really wanted to be a missionary, but instead I married my high school sweetheart and had a couple of kids. And I took a job at the best place in town to work, Springfield State Bank. They took me in as a bookkeeper because I knew how to turn on the only computer they had in the bank at the time. That was in 1989. One day, a few weeks after I was working there, one of the officers overheard me telling a customer on the phone about what's special about my bank, what's special about community banks. And he said, you know, I want you to right now go to the radio station and record that, and we're going to make that the bank's commercial. So that was in 1989, and I did that, and I still to this day write and produce all the bank's commercials, and I even sing the jingle. But more than ever, I believe in Springfield State Bank and the importance of community banking across our state. From the very beginning, Springfield State Bank invested in me. They trained me, they sent me on to banking school. They gave me opportunities along the way as I worked in every single department of the bank. Today, 32 years later, I'm executive vice president of the bank, and in 2016, I became the first woman invited to serve on their board of directors. And I'm the incoming president of the Bluegrass Community Bankers Association. And I don't share any of this as a credit to me, but to share with you the heart of what community banks have always done and continue to do, and that's invest in their community. The last 18 months in banking have been much like the tobacco season I grew up with. It's the hardest work I've ever done, but the best money I've ever made. The income that we receive from our PPP loans, just my bank, we took in right about $1 million just in the fee income. I made every single one of those loans myself, and I eyeballed every person that got the money. We made about $550 altogether, which is pretty good for our bank. We're right at $375 million in assets. So while that fee income was great, we're looking now into 2022 and wondering, where's the next pot of gold going to be? You know, where are we going to get this income? Our margins are shrinking. It's like staring into a mysterious abyss, and we don't know what's going to happen next. And as we visit with our customers, we're finding that to be the new normal, fear. What does the future hold? We hear it in every single industry. The builders can't get materials, which have tripled in price. Consumers can't afford them, but they want to build anyway. Restaurants can't get the food that they order, and they can't get workers to fix it and serve it. And this chip that's been back ordered for the automobile industry, it's causing layoffs and a lot of complications. So we hear story after story from our customers of just fear and wondering, what does the future hold? Our response to this fear is pivotal to how the community banking industry will be seen for years to come. As we balance empathy with sound business decisions and regulatory alignment, it's our job to keep our community's economy flourishing. You know, we risked our capital, about $15 million in capital, to make these PPP loans without knowing when, how, or if these loans were going to be forgiven. And we only hope that loyalty that our customers feel from us, they'll return to us in the years to come so we can remain strong. A couple of Sundays ago, my preacher was talking about miracles he's experienced. He shared about the journey of our church, River of Life, which started 21 years ago with 80 people, and these were not 80 wealthy people. Just 80 people, and all we had was an extension cord. That was our only property. How in the world did we get to be a congregation of over 400 people with a multi-purpose facility on 40 acres of prime land right outside the city limits? It's a miracle, he said. It seemed impossible, but it happened. He shared how Springfield State Bank listened to the vision of these leaders and believed in River of Life Church. Our bank president is not a member of my church, but he knew us. And it did not make sense on paper, but he knew us. I kind of think he knew from the get-go that examiners would scrutinize this loan, and they did. but he did it anyway because he knew us and he believed in us. And it's not something that, my bank would boast about, but I'm proud of it. I'm proud of my bank that this is the way we do business. My president will from time to time pull out that loan and say, I think we can lower this rate again. And who does that? Community banks. That's who we are. So what struggles are community banks facing today, August 3rd, 2021, that we didn't face August 3rd, 2019? Earnings, as you've heard Commissioner Vice speak about, loan demand starting to return, but it's just so hard for us to compete with all of the other, the mortgage brokers and the non-bank banks. They don't have the same regulatory requirements that we do or pay the same taxes that we do, so we struggle to compete with their rates. Deposits, we have plenty, but the pressure to pay more to keep them is relentless. When people take their deposit somewhere else, they usually take the relationship as well. So we have all this money and nothing to do with it. Staff, have you tried recruiting a millennial? The struggle is real. They are wonderful, but so tricky to attract and retain, which plays in hand with management succession. Who's going to be running our banks in 10 to 15 years as this new generation evolves? Keeping employees healthy and safe is another challenge. We used to be a bank where employees came to work as long as they had a pulse. And today we call in sick at the sign of any symptom, just so we can be extremely careful. Third-party vendors is another area of concern. Our bank is different than most because we do all of our processing in-house. We stuff our own statements, we do our own work, and we don't hire a third party unless there's no other way to get the job done. But recently, one of our third-party vendors, Kaseya, they provide patch management for our system, and they have about 40,000 businesses globally that they do this for. They were hit with ransomware. And, I don't really think of ransomware coming from a company that is supposed to specialize in computer security and network security, but this is who hackers are out to get, because it's like dominoes. If they take that third-party vendor out, then we all fall down. So they had about 200 customers to get hit with ransomware. And it made us take a step back and realize that more and more we are going to have to do our own work. And we're not going to be able to trust the third-party vendors, even though they've checked off all the boxes and they've done their due diligence. We still are responsible for the safety of our customers' information. And you were mentioning crypto earlier. If you get hit with ransomware, you have to pay the ransom in crypto. So there again, banks have got to be familiar with crypto, because if you get hit with ransomware, you're going to have to pay and you're going to have to use it. So we're lucky we weren't affected, but to mitigate the risk, we just quit using their service. We do the work on our own, and going to continue to focus inward and just take care of our small space in Springfield. And then, that leads into the cost of technology and compliance. Community banks don't have the extensive staff and the budgets of the larger banks, but we still have to go by the same requirements and have the same expectations, and that's a struggle. The competition that we're facing with the non-bank banks, such as insurance companies, credit unions, ag agencies, mortgage brokers, online lenders, they easily undercut our rates and, again, don't have to comply with the same regulations and restrictions that we do. And speaking of regulations, this is not an issue. The regulatory agencies have been nothing but wonderful during this pandemic, and I want to take a minute just to applaud them. They've been so supportive during this uncertain time. They've been proactive in finding ways to make our jobs doable. And at a time when we all felt quarantined and isolated, they went the extra mile to make sure they were very present in our bank. And Commissioner Vice actually sat in on our last exit meeting. It was at a board meeting, and it was just incredible to hear from him and have him personally applaud our bank for our rating, which I can't share, but it was good. And it's something we take a lot of pride in. So I am very pleased with the regulatory agencies and how they have assisted us through this pandemic. And last thing I want to talk about is relevance. I hope there's never a time that people say, remember the time when we had community banks? You remember the time when you could go into the lobby and, ask the teller how much rain she had or how many inches of snow you had to drive through to get to the bank? And remember when applying for a loan meant that you met with the lender and he talked about your budget and he coached you and helped you find a good solution for your needs instead of just filling out an online form? And they knew your name and they knew your family and they supported your business and they helped your grandmother restore her stolen identity. I hope that day never comes. So this is my State of Community Banking address. And I guess somebody overheard me talking about community banks and thought I'd do okay at this. So it's something I definitely believe in. And I hope I've shed some light on the challenges we face, but also the rewards that we experience in helping our communities thrive. And I just thank you for your attention and invite any questions you might have.
Thank you, Christy. Thank you for being here this morning. I think we do have a question from Representative McCormick.
I don't have a question. I think that as a legislative body that we need to make sure that we do what needs to be done to protect our community banks. My entire life, our community bank just recently sold to a much larger banking institution. And so I just encourage the legislation to support what your needs are. Secondly, I've been a member of a credit union for 35 years, and I'm a big supporter of credit unions. I have some concerns with the global banking institutions that's taking over. That it gives me some great concerns. My husband grew up in banking. My mother-in-law was vice president of a larger bank at home, and he literally grew up playing in the vault. And he's also a member of the Nomastic Association. He's big into the coin, silver and gold. And I constantly hear from him what's taking place because he works the big conferences in Nomastics. And he's out there and he hears all that's going on from the mints all the way down to your local collectors and vendors that sell. So big concern that if we get away from our smaller banking institutions that we're headed towards globalization in our banking, and do we want them to have control of our money? And as you say, I don't feel secure with large deposits, anything over what is insured by the banking institution, and nobody really should because of, as you say, the cyber attacks. So the banks can only handle so much, and you're only insured to a certain amount. So people need to be focused on that. So should legislation. So anything, laws or whatever, please bring them to our attention that we can do to assist to keep things as they should be.
Thank you.
Thank you, Representative. Any other member of the committee seeking recognition for a question or comment? If not, thank you again, Christy, for being here.
I would like to respond to Representative Roberts' question about the PPP loans being we had more loans but a smaller dollar amount. Having worked with those firsthand, in the first round, self-employed individuals and farmers, they were told, use your Schedule C and your Schedule F and use the net income to calculate your benefit. Well, not many of them had a net income because they deduct their expenses. In the second round, they used their gross. They were able to do that. And so that's why we had such an influx of the smaller amounts but higher numbers. That's what we saw at our bank. So I just wanted to respond to that. Thank you very much.
Thank you. Thank you for being here. Our final presentation this morning will be the Kentucky Bankers Association. We have Ballard Cassidy, President and CEO, and other guests. If you all will, welcome and recognize yourself. for the record, and you may proceed with your presentation.
Thank you, Mr. Chairman. Mr. Chairman, members of the committee, good afternoon. It's a pleasure to be here, as always, to talk to the Banking and Insurance Committee. My name is Ballard Cassidy. I'm the president of the Kentucky Bankers Association. I have with me on my left Deborah Stamper, who is the executive vice president and general counsel to the KBA, and John Cooper, our government affairs consultant, and he's not my responsibility. I want to make that up front. No, I'm just, again, we're glad to be here. Rather than for us to sit up here and repeat the information that we knew was coming today from Commissioner Vice and from Debbie and from Christy, I knew they would do an excellent job of telling you all what was going on in the banking industry. We thought that we would like to take the opportunity to bring you all up to date on a serious issue for the future of banking in Kentucky. And that's the lack of filing technology in our county clerk's offices. Now, before detailing the issue, I want to make it clear that I am not laying fault at the feet of the county clerks for a problem that appears to be caused by a lack of funds for technology upgrades that constitute a significant one-time expense. Bankers and clerks across the state work together every day to execute your constituents' most frequent and high-stakes transactions, and that would be homes and automobiles. But this problem has been with us for decades, and this General Assembly has worked during the last several sessions on getting those transactions recorded safely and efficiently. All concerned, and that would be the banks, county clerks, automobile dealers, realtors, title companies, credit unions, home builders, mortgage bankers. We have all worked on this issue as well. And I would like to take just a minute to thank Representative Michael Meredith for his willingness in agreeing to chair the County Clerk's Office Modernization Task Force, and we thank him for that. The combined efforts of all those people I mentioned earlier have resulted in some progress. Kentucky has now passed the revised Uniform Law on Notarial Acts, or RULONA, if you like acronyms, which everybody does these days. That allows documents to be notarized electronically and or remotely. County clerks have also already been given the authority to voluntarily accept electronically recorded documents, and this legislature increased fees to help the county clerks with those efforts. But those fees did not begin to produce enough revenue to enable smaller county clerks' offices to update their technology systems so to address the core issue problem. And we'll talk a little more about that in just a second. For years, we have monitored other states across the country for effective models of electronic filing of mortgages and other documents. Our efforts to catch Kentucky up have been bogged down in the sheer number of counties that we have and the variation in the systems to which they choose to operate. Then came the perfect storm, COVID, which had the effect of basically a stress test on our county court clerks' offices. As a result, two things are now clear to everyone. One is we cannot continue on a path of allowing the adoption of electronic filing to be on a voluntary pace. And two, the necessary technology upgrades will not occur without supplement funding for the clerk's offices. As this committee is aware, Kentucky is a race notice state relative to its systems of filing legal documents affecting titles of real estate and automobiles. These transactions put a lot of money on the line, and when that happens, fraud happens. In fact, the fraudsters' technology is progressing at a pace that makes us sitting ducks, really, because of the inadequacy that we face here in Kentucky. Without timely and efficient filing, your constituents are at a substantially higher risk of expensive litigation to resolve competing claims. So imagine what it was like to buy and sell homes and cars during the COVID shutdown. The KBA began receiving calls from our members as early as March 16th of 2020 with concerns that some county clerks' offices were closed or had been very limited or were offering very limited access. The clerks did what they could to maintain some level of functioning, some allowing drop-offs outside, which they would then retrieve and file later. Others would have boxes or baskets on the sidewalks, which would accumulate documents to be filed at some undetermined point in the future. And some offices were allowing no in-person access to title searches. Some were scheduling limited appointments each day, and some were even charging for access to those files. So you may also recall that during COVID, the shutdown was a time of record low interest rates and prompted record high levels of refinancing. That made filing priority and clean titles uncertain. Uncertainty in the recording business is nothing more than a disaster waiting to happen. Then just a few weeks ago, Avis, which is the current operating system being used for the motor vehicle filing, went down because of a system error caused by a software update to the new system, Cavis. That system is being created now. Both of these problems were scary reminders of our dependence on these technologies. We won't know for a while yet whether the disruption ends up creating litigation for lenders over their rightful priorities during that time period. What happened there, however, cannot be undone. But what we can do is plan for the future and ensure that Kentucky's county clerks become a benchmark for other states. It starts with providing the county clerks with a clear and adequately funded path. That path will require three essential things of our clerks. First, a willingness and a capability to accept e-recorded documents. Right now, many clerks are working with a number of vendors who can safely and securely transfer documents from the person submitting the documents to the clerk's office and ensure that a timestamp is placed on the document in accordance with established procedures. These vendors have had no problems working with the systems that any clerk currently uses, allowing the users to select their vendor of choice, and that cost is borne by the user of the data. Second, a willingness and capability to provide electronic access to a reasonable history of filed documents for title searches. Title agencies would be the ones to specify the length of that history, but you'll find in most states that there's a 30 to 50 year of history. Right now, there are a number of vendors working with a smaller number of county clerks in Kentucky who can provide the capability for safe and secure online searches. Although the users pay for access to the system, the clerks must fund the initial creation of the database. More importantly, they must also establish a reliable indexing system, which is the basis for any usable title search, as well as maintain the documents management system. The clerks receive no part of these users' fees, and the cost to the county clerk is usually a setup fee and an annual per person licensing fee determined by the number of clerk staff that have access to the system. Third is we need a completion of the Avis to Cavis system we talked about earlier to allow registration, renewal, and transfer of motor vehicles electronically by authorized users. Although we have been involved in discussions to achieve this, we are not aware of any expected deadline or any other specifics of the final product. As such, our clerks cannot get these three things done without money, and we would propose some sources for consideration. First, certain county clerk fees were raised significantly 2 years ago. Those are the fees we talked about earlier. The specific purpose of updating needed systems and software. However, we have since learned that if these fees are not used by the collecting clerk during the fiscal year, they are being swept out for other uses. Those fees were meant to accumulate for the significant cost of the updating system. However, with the fees being swept, it is abundantly clear that a single fiscal year's collection of fees will never be able to provide the money needed for the smallest of counties. The legislature should make these fees available to clerks to help pay for the long-term projects like e-filing and searches. And I say help because even those fees are not enough. Second, the clerks also collect a per document fee, which is submitted to the Department of Library and Archives. That fee is used for grants issued by the department to other agencies for preserving records. Some county clerks have received grants from the department for creating document management systems online and document searches. However, the application process is complicated, and the money, even though collected only by the county clerks, is also granted to other agencies for unrelated projects to the filing. These grants should be prioritized for county clerks which need them, the smallest counties, to complete these technology projects. And third, funds have been provided by the state by the federal government for a variety of allowable uses, including enhancement of and implementation of necessary infrastructure projects. Kentucky has at least $1.1 billion remaining from that allotment. There is a more than justifiable argument that technology needed by essential governmental services would include these technological needs. Finally, we do understand that this kind of modernization can inspire uncertainty and fear. What kind of skills will this take? Will there be staff reductions? Those are all questions that every American is dealing with, those types of concerns in this digital age. As legitimate as those questions may sound, they can't be a reason to drag our feet, not when the next pandemic could be around the corner, which could easily create another financial chaos. Our county clerks must be empowered with funding and reasonable deadlines for getting the necessary software and systems in place, and they will need your help, which may require legislation to get it done. I want to thank you all for your time this morning. We'll also be glad to answer any questions on PPP or this or banking or anything you want to talk about. We'd be glad to. Cybersecurity, let us have it.
Thank you, Ballard. We appreciate you all being here this morning and and educating the members of the committee on that issue that I know is important to you and a lot of folks. We do have a comment or question from Representative Meredith.
I'm not going to rehash the clerk's issue. We're going to be knee-deep in that for several months still going forward, and we've got a lot of work to do, but I think we're making some progress in that realm, certainly with some of the meetings that we've had and some of the discussions that are being had over that issue. I want to go back to a comment that has kind of been a thread through some of the others. Debbie mentioned it in her presentation, and it was mentioned as well in Christy's presentation to some degree about and Commissioner Vice mentioned it in his comments too, about the influx of deposits that are coming in right now. And what a challenge that is, obviously, for banks in managing interest margins with that kind of money coming in and not having a huge increase in loan demand as well. I think the concern that I have and the concern that I think we all probably have at this point, and something that the industry needs to look at as a whole, is this a short-term artificial growth in deposits, or is this going to be a long-term growth in the monetary supply nationally and not just in Kentucky? And I don't know the answer to that. I can't project or predict that. I don't have a crystal ball, and so I wonder what everybody's thoughts are on that. Is this going to be a short-term blip on the radar? Or with most of the time that we've seen monetary supply increases over the years, is this here to stay?
That is a great question. It's probably the $50,000 question in the banking industry today. I would refer you a little bit to the Fed and what they talk about inflation and transitory, whether these are just short-term problems or the long-term problems. And what's your definition of transitory? Is it 6 months, a year, 5 years? What's going to happen? We have seen a huge influx of deposits that you talked about, and primarily from the PPP loan business. Those funds, I think at one point, 75% of those funds had stayed inside the banks that were not being used for the purpose of what they were intended to be used for, but they were becoming part of the bank. What we see are additional funds being offered out of Washington for additional programs. So I think as long as the spigot is on, so to speak, for dollars, and as long as the federal government is pouring money into the economy like they are, I think we're probably going to have that problem to face. It was talked about earlier, the what to do with that money. And when you think about it, the banking industry just got through loaning all of their businesses the money they needed to do what they were wanting to do. So you're sitting there looking at who's left for me to lend money to. So most everybody in the communities that needed the money had gotten the money. So it is a problem.
And if I could follow up, I think the big concern, and that we all have to be looking at in the industry, is if we grow our loan bases with this amount of money, and it is an artificial short-term type of situation, then you have liquidity issues.
Right.
If it's a long-term issue, then we're going to have to grow our loan demands to be able to put up an interest margin that works and can continue to make our banks viable. And so that, like you said, it's the $50,000 question. I think it's something we all in the industry need to be thinking about and trying to figure out how we move forward with that.
You hear a whole lot of conversation at meetings that I go to with my counterparts about this very issue and whether or not the time has come to quit offering interest on deposits, for example. If you have no loan demand, you don't need a bigger truck when you take deposits. So I mean, there's all sorts of things being talked about in the banking industry. I think, well, as Commissioner Vice, I think the banking industry is trying to do the right thing by not making any changes until they absolutely have to. And I think we're a ways away from that right now, but not too far away.
One more thing.
One more, Representative Meredith.
And I just want to address one other thing to Representative Roberts' comments about PPP earlier, and Christy addressed this partially, but the other addition that I would say about the smaller dollar loans with regard to PPP also goes back to the second round of the PPP funding had requirements about reductions in income for those companies over the last year that had applied for those. And so many of your larger companies may have not seen a 25% reduction in a quarter of their income. And so if you look at, this was really targeted to a lot of those smaller companies who were really, really struggling. And I think that's one of the reasons that you saw the smaller dollar amount, because some of those large companies that were eligible in the first round, because of that 25% gross revenue reduction, were not eligible in the second round.
Yeah, and if I could add to that, Representative Roberts, in addition to that, the businesses were finding it, there was a formula you had to follow, and it had to do with employees, it had to do with revenue, and you had to get, I think it was 75% of all of that money had to go to your employees. Well, they couldn't get employees. The restaurants, for example, that thought they had 25 employees, when they went back and said, okay, I've got the money for me to pay you, they were making more money staying at home, and they basically just said no thank you. And so what a lot of those small businesses found out was they were turning the money back in, right, because they did not want to be stuck with the loan, even though it was only a 1% loan, which I would take most days. But they did not want to be stuck with it because they didn't know if you looked at PPP in its entirety, from 30,000 feet. At what happened, it was like building a plane while you're flying it. The banks had no idea, the businesses had no idea, there were no rules, there were guidelines, and the banks were throwing all those billions of dollars of capital, their own capital, out on a promise, basically. So those numbers went down, and I think Christy hit on it. Part of one of those reasons was I think it was the second or third advancement was also for minority businesses primarily. And so that was one of the reasons why those numbers went down as well.
We'll take a final question or comment from Representative Smith, and then we'll get to our final.
Thank you, Mr. Chairman. John, I want to first apologize. It's been years since we've run into each other, and I've walked right past you. I recognize you now. I want to see if you can give some perspective on our banks on the crypto. I know I'm not trying to beat a horse to death here, but I'd like to have your perspective on, do you have institutions investing in it? Do you have any kind of inside association discussions on the future? And I'm saying this because I really believe it's here, and I believe it's going to be here for a while and in the future. And I say that in saying, when you I walked into a business and seen an ATM machine that was a Bitcoin. So the reason I asked the commissioner, are they regulated? Why they're sitting in businesses? So there's transfer of funds. Again, on the banking perspective, what is your association internal discussions, if you're privy to tell them? And is there banking institutions in Kentucky investing in it?
Representative Smith, I ought to make him answer that question for you, but if you don't mind, I'll give it a shot.
I'll add one thing to it.
Okay.
There's a ton of discussion on cryptocurrency. The volatility of that, not of all cryptocurrencies, is right now a problem. You can wake up one morning and lose 15% in value. So if you paid somebody a crypto coin to buy a car, then the car dealer lost 15% of the value of what he just sold the car for yesterday. And so volatility is a problem. The Fed has come out, and you alluded to this earlier in your question, which was very astute. The Fed has come out with the guidelines on what it's going to take for them to accept cryptocurrency to have access to the payment system. And that's what cryptocurrency is after. They have to have access to the payment system in order to become a viable, long-term viable transaction coin, from lack of a better phrase. The Fed, in those guidelines, one of the primary points they wanted to make was that you could not have that kind of volatility and be part of the payment system, purely because of the protection of depositors and protection of the public, which is what the Fed is interested in. The Fed is currently working on, as you know, a crypto coin, and you alluded to that earlier as well. I'm like you, I don't really know what's going to happen. I know there's a ton of conversation around it. I just left a meeting the other day where that was probably took a 2-hour conversation on cryptocurrency. The interesting thing to me, just personally, not representing the banks, but for me personally, I don't really know how the Fed would give up access to the payment system. And if they don't come out with their own crypto coin, if the Fed doesn't come out with their own crypto coin, then that's in essence what they'll be doing. The Fed fights tooth and nail to keep access to that payment system. And so it'll be interesting to see, because what you alluded to earlier is happening. You're starting to see people take it in exchange for different things, and ATM machines for crypto and so forth. It's all sort of working behind the scenes. You've got people who are really pushing it and really trying to get it there. On the other hand, you've got the Fed, who is responsible for the safety, soundness, and that kind of stuff of the system, of the payment system, and they're going to clash eventually. And the question is going to be whether or not the Fed will let them have access to the payment system, or will the Fed come out with their own crypto coin.
And my point, and Ballard said it, my point is that the Fed's going to have to lead on this. I mean, you can't. I think the thing that worries me the most is a patchwork of state laws relating to a payment system that is international. I just think the Fed has to lead on this. It's dangerous.
And the regulators would never, because of the volatility that Ballard mentioned, regulators would never accept investment in crypto coin. We have arguments with regulators all the time on whether the banks have valued a piece of commercial property properly. And so to look at Bitcoin or any other cryptocurrency and see if that's valued properly, if they accept that in a transaction, would be a red flag for the regulators. It would be very difficult for a community bank to get involved. The largest banks can get involved.
So
because
you're
it's
answering my
them.
question then, Mr. Chairman. There is no investment from the banking industry in Kentucky into crypto.
Not that I'm aware of, no, sir.
Okay.
Not that we're aware of.
Thank you. Thank you all for being here, as always.
Thank you, Mr. Chairman. Appreciate it. Thank you all for your time.
It's good to get a chance to eyeball you guys again.
Yeah.
You know, I'm kind of like that. I mean, we miss that. The trying to advocate by wire is difficult, obviously, clearly.
Definitely is. We've enjoyed it as well. Thank you all.
Thanks.
We'll move on to the last agenda item this morning. I was just informed the transportation has this committee room starting at 1. At this time, we will introduce a resolution adjourning the Interim Joint Committee in Banking and Insurance in honor and loving memory of Senator Tom Buford. And I'm going to turn it over to my co-chair and his colleague, Senator Carpenter, for some comments.
Thank you, Mr. Chairman. I'll ask the Secretary to call the roll, and then we'll have opportunity for a few, not to call the roll, but just read the resolution in its entirety, and then we'll have some opportunity for comments.
A resolution adjourning the Interim Joint Committee on Banking and Insurance in honor and loving memory of Senator Tom Buford. Whereas Senator Buford proudly served this Commonwealth as state senator for the 22nd District for 3 decades, serving from 1991 to 2021. And whereas Senator Buford was a member of both the Senate and Interim Joint Committees on Banking and Insurance for the duration of his 30 years of service in the Kentucky. And whereas during his tenure as a Banking and Insurance Committee member, Senator Buford led the committees in the role of chair and co-chair for nearly 2 decades, from 1999 to 2017. And whereas Senator Buford also served in a number of other roles as a member of the Kentucky Senate, and whereas these roles included serving as a member of other legislative committees, including Appropriations and Revenue and Licenses, Occupations, and Administrative Regulations, serving as Minority Caucus Chair from 1993 to 1996, and serving as Minority Whip from 1991 to 1992. And whereas during his time in the legislature, Senator Buford was the primary sponsor of more than 450 Senate bills, of which over 100 were passed by the General Assembly, and he sponsored approximately 320 Senate resolutions, of which almost 300 were adopted by the General Assembly. And whereas these legislative initiatives included more than 24 pieces of enacted legislation relating to banking and insurance, including legislation relating to the regulation of banks, insurance companies, pawnbrokers, and money transmitters. Legislation relating to regulation of the security industry, and legislation relating to the regulation of health insurance. And whereas Senator Tom Buford is rightfully honored on this day for his service to this committee and to this Commonwealth. His tireless work on behalf of his constituents is justly acknowledged, and his professionalism, wit, and leadership is deeply appreciated by the members of this. And whereas Senator Tom Buford, esteemed member of the Kentucky General Assembly and cherished husband, father, grandfather, friend, colleague, and community member, departed this earthly life on July 6, 2021, leaving all those whose lives he touched in solemn mourning. Now, therefore, be it resolved by the Interim Joint Committee on Banking and Insurance of the Legislative Research Commission of the Commonwealth of Kentucky, the members of the Interim Joint Committee on Banking and Insurance, both individually and collectively, hereby express their most profound sympathy upon the passing of Kentucky State and extend heartfelt condolences to his family, friends, and community in this time of loss. When the Interim Joint Committee on Banking and Insurance adjourns this day, August 3rd, 2021, it does so in honor and loving memory of Senator Tom Buford.
Well, thank you. In true Tom Buford fashion, he'd probably vote no on his own resolution. Tom, I've been here 11 years now. When I first came, Tom was on this board, on this committee, and when you walked in the room, Tom looked like a state senator. And he used that. And anywhere we traveled, or anytime I was with Tom, he had a personality that people always was attracted to and always came to. I was on a piece of equipment working on a house when they called me and told me that Tom had passed. And it really hit my gut. And I had to stop and just think and reflect on my friendship with Tom. how he kind of been a mentor, and we had so many similarities. We both are always in the back corner talking to each other the entire time during committees, and we were in session. They had us on the back row on the Senate floor side by side, and everybody's like, you two have to be side by side because the rest of us can't get a word in edgewise. And so, he was just a really unique guy, and anybody who can serve up here for 30 years and went through all the things that he's went through, from Bop Trot to all these different processes that's went through the legislative body, and still come through with honor. And, he was just a really good friend to me. There's going to be more opportunities for us to talk about Tom, but, Tom, with true Tom fashion, didn't want a lot of recognition. We talked about, are we going to do anything to honor Tom, and is the family going to do something? And Tom basically said that he didn't want to be honored with anything other than, everybody knowing how much he cared for him and his appreciation for being able to serve his constituents. And he didn't want a big fancy funeral, and he didn't want a bunch of people standing in line, and he just wanted to pass on through. And all of us in the Senate have talked about it, and we, people that have been friends of colleagues of Tom's. 30 years up here is a really long time. He's outlived and outserved a lot of people. And the last time I was with Tom, we were at an NCOIL conference, and I don't travel to very many conferences, and we were there. And this was just a few months ago. This was in May, and Tom was in a great spirit. Chairman Rowland and I were with him. We had dinner with him. We went to a function with him. He was laughing and just doing truly Tom things. And, when we go to these meetings, a lot of times they ask the chairman to stand up and speak, and I always have to carry on a joke that Tom would always carry on, because when I was up here, he always made sure everybody was laughing. And so I just wanted to honor him today. We wanted to honor him. This body wanted to honor him for his service, his dedication, his friendship, and truly what legacy he has left with the legislative body and the Kentucky Senate, and his legacy as chairman of banking and insurance. And he's a true friend that's going to be missed, because anytime I saw him, he always asked about my family, asked about my kids, and asked about my business and how life was going. And so I'm going to miss Tom on the back row. When session starts back, it's not going to be the same, and he's a true friend that's going to be missed, and I just wanted to have this opportunity to honor him. And if anybody else had a comment or question or a statement that they'd like to make on Tom's behalf, I know it's time now. Everybody could tell a story, but we just wanted to make sure that we served our first committee meeting as an opportunity to honor Tom's legacy and his friendship for everything he's done for the Commonwealth.
Representative Lockett.
Thank you so much. I just wanted to say briefly that Senator Buford was a phenomenal friend of mine. He is one of the reasons why I even ran for office. He was my state senator. And just like you, Senator, when I heard the news of his passing, it was kind of like a big punch in the gut. And I reached out to his family and expressed to them really what Tom meant to me. This past session, I enjoyed texting back and forth with Senator Buford, and he would tell me how to vote on certain bills and what to vote on. Matt, don't vote on that bill. That's not a good one for you to vote on. Matt, this is a great one. Vote on that one. And I just appreciate his not just his humor, but the way that he represented Jessamine County in the 22nd District. He was a stalwart, and he will certainly be missed on a personal level, but also certainly be missed as our state senator.
Thank you. And also, excuse me. Also enjoyed my time as co-chair with Tom Buford and getting to know him and his humorous personality. I asked him in 2017 when we first took over and I became chairman of the committee, I said, Tom, do you have any advice for me? He said, sure, just you over in the House, you all take up any bill that you want to, pass it out of your committee, send it to me, and we probably won't do anything with it. And that happened more often than not. And so you just always, you never knew where Tom was going to stand on any issue, and he thought he was going to be for it. He might surprise you, but he was a pleasure to work with, and he will be missed by us all. At this time, I will entertain. I guess I'll entertain a motion to pass the resolution. Motion and a second. All those in favor? Aye. And the resolution is adopted, and we will communicate that to his family and make sure that they get a copy of that. So thank you all. Sorry for running so long today. At this time, I'll entertain a motion for adjournment. We're adjourned.